welcome to part 2 of tax strategies for real estate professionals. If you haven't yet watched part 1, we suggest you go back and view part 1 first. This course is sponsored by RMS Accounting. RMS Accounting is a full-service accounting, tax, bookkeeping, payroll, and financial management firm, and by Royal Management Services. Royal Management Services is a community association manager for South Florida, managing condos, HOAs, and co-ops. The audio was recorded at a live seminar.
The federal poverty level, you still qualify for a credit. However, if you go from 399.9% to the 400% and you got the $12,000 I talked about earlier, you either shouldn't have gotten it or anything, you now have to pay it all back. Okay, it's a real issue. I had clients come in that said, listen, I'm going to get a bonus at the end of the year, and we ran this number, and we said, well, you were at 300% of the federal poverty rate. That's great, you got this credit, and if you stay between 300 and 400, you don't have to pay the credit back. But if you hit 400% of the federal poverty rate and $1, you have to pay all that money back, and they have to look at their boss and say, remember that $8,000 bonus you were going to give me for my sales commissions for this year? That's going to cost me $12,000 I have to pay back. So there's really some tricks and tribbles in this, especially this percentage of the federal poverty rate where, I didn't know my kid made. I thought I was under, and now I find out my kid makes that $15,000, and that pushes me over, because remember, it's household, not my income. Okay? Okay, the premium assistance credit, that's the credit that we get. Okay, your household income is over, I've already talked about that. Okay, and you need some kind of certificate of coverage that you had met. If you were in the exchange, you will get a 1095A this year. And you may have to go online and download it at your account at healthcare.gov. To get that, it'll have all the information. If you worked for an employer this year, they don't have to provide that till next year. If you, large insurance company, even independent, nobody else has to provide the proof till next year. You just have to certify that you did have health insurance coverage. So I have an insurance card. If you were in Medicare or Medicaid, those things count for MEC. Okay? So, you get old enough and poor enough that you can get out of some of this. Health insurance is required, like as I told you, all members of your household. The penalty is based on the number of members that don't have insurance. If the cost of insurance was over 9% of your household income, that's an exemption. Now you don't have to have the insurance. Okay? So I was at an employer. They figured out it was going to be more than 9% of my household income. How my employer would know my household, I don't know. But when we get all done, I say, here, I added up me, the kid that's got the money and everything else. They told me, here's the quote for the insurance. It was going to be 9.5%. I'm exempt. I don't have to have health care. Okay? Premium assistance credit only through, and if you're over 400%, I told you lose that. Okay? The insurance, your employer cannot send you, they can't do, we'll reimburse you for what's going. In fact, there's all sorts of employer penalties. Can't have insurance through an employer to go to exchange. If I say to my employees, I offer insurance, and it's deemed to be affordable, which is under 8.5% of their, okay, they can't go to the exchange and say, I don't have insurance and apply for the credit. Even if the credit would mean they were only paying 5%. They don't want you double dipping, and large employers are going to hit with a penalty if their employees show up there. Okay, everybody thinks it's a $95 penalty. It's not. It's $95 per adult member of your household. That's member over 18, or 18 or over actually, plus $47.50 for each child. It maxes out when you have 5 members, no matter what the mix is. So if you have 10 kids, you're in good shape here because it maxes out at 5. Okay? Or 1% of that combined household income. So everybody thinks I'm going to pay this. Me, I'm going to pay the $95. Screw this, I'm not going to have to pay for it. They miss this part. Okay? There's just me and my wife, $190, but we make $100,000 a year. The standard deduction is 12.4 times 1%. Our penalty this year is $876. This is another place where the tax code says, compute it two ways and pay the biggest. Okay? So when I'm talking to clients all the time, their friends told them that the most they're going to have to pay is $95 a person. So they didn't buy any health care. No, that's the least you're going to have to pay. Okay? There are a whole bunch of exemptions. Some of them are just claimed on the tax return. Some of them require you to go back to healthcare.gov and get them to certify the exemption for you. Okay, so if you didn't have health care, now one of the exemptions that does work, first of all, if you have health insurance one day during a month, you have neck coverage one day during the month, you're covered for the month. So if your plan quit on January 2nd, because that's when it was paid through, then you had coverage and you don't have to pay anything for January. Okay? If you have no more than 3 months that you're uncovered for, you can exempt for 3 months. So, gee, my plan quit January 1st, February, March, and April, I didn't have any coverage. Okay? May 25th, I got coverage. Well, I now had coverage for all of May. I wasn't over the 3 months. I can be exempt for the 3 months. And the 3 months, it's figured per member, every member of the household you do this. I can't do it twice. I had it for a day, now I'll go another 3 months. No, they were smarter than that. So, but you can get the list of the exemptions and what you have to do. You do have to print it on healthcare.gov and then you have to mail it to them. And they have to send it back. The good news is, if you filled it out and provided, we can say, we don't have to have the certificate this year, they're letting us say it has been applied for. But the rumor has it they're going to go back and look at all of the applied for returns and match them because they're going to have this from healthcare.gov. Okay. When you go to your tax professional, whoever that is, have proof of your insurance. Some will believe you, some will ask for proof. We like to put it in the file because when the government comes later, we can go, see, we already have it, because people, oh, I had health insurance 2 years ago, now they're looking for it. You threw that card away. You won't have it. If I have it, if I've touched it, it'll be in my files, whether you threw it away or not. Look closely at who you claim as a dependent. They may not be worth what they used to be, because now you got to add their income in, you got to add their penalty in. Might not want mom and dad or somebody else that doesn't have health care as my dependent anymore. Remember, if you receive the premium assistance credit, okay, and your income is higher, you may have to pay it back. You could have to pay back as much as 100% of what you received, depending on where you're at. Okay, so now we're talking a little bit about Social Security. If you think Social Security is a great investment, I want to pay as much as I can, because when I get old, I'm going to get a big check from the Social Security Administration. Then ignore most of this. Then you just run your taxes up and pay it. But as a real estate professional, if you have not incorporated your Schedule C, whatever your net income is going to be subject to Social Security. Only we don't call it that for you, we call it self-employment tax. Okay, it's Social Security, folks. It's going to the Social Security Administration, who will throw it away.
Isn't there a time that it stops, like you've paid in so much
No,
over the years?
no. If you're 108 and you work and you earn more than, based on this year's number, $433 as a self-employed, you pay in Social Security. If you go to work at Publix, you pay in Social Security. You never, ever stop paying. Medicare goes on forever. You're earning, you're paying it. My clients tell me all the time, but I'm collecting Social Security, I shouldn't have to pay it. They don't care. Okay? I'm too old, I don't have to pay it. There is no age limitation. Okay? Taxes are not, you're 121 years old and you earn enough money to have to pay, you gotta pay. There's no, oh, I'm opt out. These are things, there's rumors out there, people, oh, when you get to be this old, you know. No. You gotta pay. Okay? But anyway, you need to remember that that's Social Security. So the advantage is to just pay on Social Security. It's simple. You don't have to do a lot. Okay? You don't have to have a separate account. You just, it gets added in your checks. You send them the money. All right? So your Schedule C, Okay, the audit, the record keeping is simple. Man, all I need is a piece of paper. Here's, I added up what I got. I added up my expenses. I don't have to have the books and records of a corp. I don't need a separate bank account. Okay, I don't need any of that stuff if I'm a Schedule C sole proprietor. It's easy. A lot of my clients go in the living room and they get a bunch of file folders and they say, okay, here's all the money I spent on marketing, and they stack up the receipts and they run an adding machine tape, and they come in here and they read off the numbers. Okay, and there is no real official books and records. Is it nice if you have them? Sure. But the IRS can't say, you didn't keep a cash receipts journal. You didn't keep a bank journal. You know, you can put it in your personal account. You're a sole proprietor. It's like, this pocket's my money, this pocket's my money, but I'm using it for the company. I'm a sole proprietor. Goes on my 1040 tax return. Okay, so it's just another schedule that we throw in. Okay, the record keeping's simple. Professional fees are lower. You don't have to pay for another return. Okay, there's no separate bank account because they charge for business bank accounts now. Okay, you don't need any of that nonsense. Okay, it's easy. The disadvantages: higher audit profile. Okay, a real estate professional that makes $40,000. I hate to tell you, in the real estate world, that's a lot of money because everybody that ever had a license and got a commission is filing the same form, okay, with $3,000 or $4,000. So you don't have to make a lot of money to be seen as a big fish. Do you follow me? You know, I make $50,000 or $100,000 that gets me up there. So it gets my audit higher than an S corporation. Okay, I have to pay self-employment tax, not just on part of it, on all of it in a self-employment. Okay, in S corp I do part of it. Okay. I have unlimited liability. Not really a problem because nobody can stop you from being, you know, if you lie about a deal or don't do the right thing, you're liable, there's no question. But if you have a secretary that works for you and you say to her, hey, while you're out, pick me up lunch at the cantina down the street, and she runs somebody over, you are personally liable for her. If she doesn't have any insurance, that's why we're a corp, because I have 16 people running around here, and I love them all dearly. But not enough that I want somebody coming to my door and taking my personal assets. So there is some liability protection. It's usually limited for small real estate salespeople because they don't have employees that work for them. Okay, so that comes into play. You're always liable for your own acts, but not the acts of others. Okay, Subchapter S corporation. So you can set up a corp. You can make an election under the tax code to be treated under Subchapter S of the Internal Revenue Service Code, which stands for small business. Okay? And there are advantages and disadvantages. The biggest advantage is we can limit the amount we pay for Social Security. Okay? The second advantage is, we'll come in and we'll get to there, but the disadvantage is now I need to have it separate. I need a separate business bank account. Can't run the money through mine, got to have a business account. You know, my banker's going to charge me. I need to keep books and records like a business would, you know, cash receipts, cash disbursements, QuickBooks, whatever. Okay, I have to have a balance sheet. I have to file with the state every year. There's an annual filing fee to keep my corporation alive. I got to keep better records. I can't just have these little pieces of paper. Okay, I have to file a separate corporate tax return, so there's going to be additional accounting fees and tax return fees. It costs me some extra money to maintain. We typically tell clients the cost of being incorporated is about $2,000 a year. Okay? It's going to cost you about $2,000 a year. It might be less, but figure $2,000. So if you're making enough money, is it worth it? Yes, I have a lot of real estate people that are Subchapter S. The advantages are you can eliminate a large part of the SE tax. Okay? I have a $100,000 profit. I take $24,000 in salary. Just payroll. I pay Social Security tax on that. Okay, I pass the rest of my money through. It passes through as a dividend from an S corp. I pay no Social Security tax on it, no Medicare tax. So if I think that 15% I'm now paying Social Security, I can put in my pocket and invest for myself better. Okay, that's why, because we're in the same boat in a accounting corp. Okay, I take a large part of my compensation is a dividend from the profit of the company. It's not salary. It's not subject to self-employment tax. I'm a good boy. I take that money and I invest it for myself because I think that in the long run, I will do better with that money than the government will. The audit risk is somewhat lower, okay, and it limits personal liability for the acts of others. I told you I have 6. If something happens, I don't want to be on the hook because they were stopping by the post office on their way home. So we're able to do that. So I ran some numbers for you. $100,000 net, after you paid all the everything but you, paid all the expenses, the referral fees, the advertising, all the stuff you had to pay. Okay? If I was an S Corp, I do have to have some payroll. I have to pay some Social Security. Okay? Number one rule in taxes. Pigs get fat and hogs get slaughtered. Okay? So if you try to not pay any, you're going to be a hog and you're going to get slaughtered. So I take $24,000. I now have to pay payroll taxes on it, mostly Social Security. There's $100 and something worth of unemployment tax. Okay, costs me $2,081. Gives me a net profit of $73,919. Okay, I, as the owner of this company here, I've got $100,000, so I don't take any of those in the sole proprietorship. I, as the owner of this company, have total income. I have the $73,000 plus the $24,000 that I got on the W-2, $97,919. Over here, they're nice to me. The Social Security self-employment tax, I get credit for half of it. So I had 14, I got to take half of it off my income because that's the employer side. Okay, so here I got 92 of taxable income. Income tax is going to be exactly the same on these two numbers, computed the same way. I mean, not the dollar amount, but it's the same number. The difference here is, here I have, on this entire amount, $14,130 worth of Social Security tax I have to pay. So if I take that, and in a 25% tax bracket, I add that to the $23,200, I'm assuming that you don't have any other standard deduction or anything here, because somebody else used it. This is extra income to make it easy. I paid, you might not be at 25% rate, I paid $23,233. I have a total tax bill, which comes out of my pocket, of $37,363. Over here on my S Corporation, I have a total tax bill. In reality, if the income tax is $24,488, plus I had to pay this in, okay? So, I have a little bit more of this, but I've got really a $10,000 total savings. Okay? I take $10,000 to the bank I wouldn't have taken. Since it's going to cost me $2,000 a year to do this, is it worth spending $2,000 to save $10,000? Absolutely. And if I think I'm going to be a high earner in the real estate business, I want to be an S Corp. The trouble is, everybody shows up here in January and says to me, should I do this or not? Okay? And I look at them and say the same thing. How much are you going to make this year? And all the real estate people tell me the same thing. I don't know. Well, then neither do I. Because you can't do it after the fact. After the broker cuts the check and pays you. I have done it. I have had real estate salespeople come in and say, listen, I just sold a commercial shopping center, and I'm going to get a $400,000 check this year, and I don't want to pay out with that, remember you talked about that S Corporation? And I say, great. And they say, it closed, but my broker hasn't paid me yet. We'll set up the S Corp, it'll take 48 hours. Have the broker sit on your payment and not write the check until we're done. And as long as it's a brokerage firm that you know that they're not going to take the money and go to Vegas, okay, you waited an extra week to get paid, and you saved $15,000 or $18,000 in income tax. So it can be done that way. The best time to do it is at the beginning of the year because then everything's in it. But you have to have an idea, if I'm only going to make, if my gross commissions this year are going to be 30 grand, and I'm going to have expenses, so I'm going to net 15 grand, don't bother with this. I'm retired. I do 2 deals a year. I remember, come and see me when the shopping center sells and it's going to close and we need to act right away, and we can get in. But if yeah, I'm a big producer, and most years I'm going to produce, and I'm really going to be putting in, an S Corp can be a really good savings vehicle. And we use it a lot in real estate, and FREC says you do not have to be a broker to qualify the Corp as long as you are the sole shareholder and owner and hold a real estate license. So you can't make your wife an owner too if she's not a licensed salesperson. But if you're the sole owner, a one-member S Corp, they have no problem with. They have no problem with it being paid. Okay, so let's talk a little about rental activity. Real estate professionals who materially participate, okay, in the activity are treated as non-passive. So if you all remember the 86 Tax Act, oh God save me now. Okay, the 86 Tax Act, which contributed to the real estate market crash greatly, said if I have a rental property and I lose money on it, and I cannot use that loss to offset income from other activities. So back in '85, I had a doctor come in who was a surgeon, and he had a deal. He was going to buy a high-rise here in town. It was rental property, and he was making in those days $500,000 a year as a cardiac surgeon. And he was going to buy this rental property because he would lose $100,000 a year. But he was in a 79% tax bracket. We had really high rates then. And the guy selling it to him said, you'll get to write off the $100,000 a year, so it will only cost you $29,000 in real money. The building will appreciate over time. You'll get all these great tax write-offs. And he came in to see me, and he said, is this true? And I said, absolutely. This is early '85. And I said, but I would not do this. And he said, why not? I said, because the only reason this deal makes any sense is because of the tax benefits. And Congress is in session. We hadn't had a lot of tax law. But I don't like to, if the tax benefits make a good deal better, that's great. If my return goes from 7% to 9%, but when my return goes from negative to less negative, because I hope it's going to be worth something more in the future, I would not do this. And he said, well, you're not the accountant for me, and he left. And at the end of 1986, with the new Tax Act, he came back and he said, my accountant said I can't write off that $100,000 loss on the building. He said I don't have active participation, and I'm not a material participant, and I make too much money. And I said, yep, make more than $150,000, can't write anything off. Okay, you're not in a real estate trader business, this isn't going to work. And he said, but it's costing me $100,000 a year, and the broker just told me that the building just dropped in is worth 25% less than the day I bought it, because nobody else gets the tax break either. And I can't, what am I going to do? And I said, I don't know what you're going to do. And well, somebody suggested I go bankrupt. I said, did you sign a guarantee to the bank? Yeah. You still making $500,000 a year? Yeah. There's no judge in the country that's going to let you go bankrupt and not pay it back. So I'm really sorry, but you did the wrong thing because the rules changed and there wasn't economic benefit, which is what they did. Okay? But if you're in a real estate trader profession and you materially participate, and that's become even more important. Nobody used to listen to my material participation speech. Because the real estate people are saying, I make money, I'm not losing money, my property makes money, so I don't have to worry about proving that I materially participate. And we said, you're right, because the IRS only cares if you're making a loss so that you can deduct the loss. Well, the Health Care Act changes all that, because material participation now doesn't only let you deduct the loss, but it determines whether your profit is going to be subject to the additional 3.8% Medicare tax for investment income. So if you don't materially participate, it's an investment activity, and if you're a high-income taxpayer, in addition to the tax rate, you're going to pay the Medicare, the extra Medicare tax for Obamacare. So all of a sudden it becomes very meaningful. Okay, those that qualify, I told you can deduct it. Okay, you get up to 25. If you're not a real estate professional, you can only take $25,000 worth of losses. Your income has to be under $150,000 even to qualify for any of those losses. You still have to mature up to it. But if you're a real estate professional, okay, and you spend your time doing real estate work is defined, but you need to keep records of how much time. Now, the other problem that comes about is my real estate professional, it says, I have 4 rental properties. Duplex A, Duplex B, Duplex C, and Duplex D. That's great. And he says, but I don't have enough hours to material participate in A, B, C, or D. But as a group, I do. Well, the answer is you have to make an election to treat the group, even though they're 4 separate properties, as one activity. I can make that election. I can say, these are all rental, don't care that they're on separate parts of the city, A, B, and C are one activity. That's good, gets me in for material participation, but if I lose money on one property and I sell it, I can't release any passive losses if I have it. So there's a little give and a little take, and you have to talk about it. But anyway, if you meet these things, you qualify. More than 50% of your personal services during the year are performed in a real property, trade, or business in which you materially participate. You have to spend 750 hours during the year, minimum, in the at least the real property, trade, or business. Okay, you need to have the records for this. Here's how much time I spend, because now the IRS is going to care because of the Medicare tax. Not just about losses, but about profits. Okay, they define real property, trades, or business, comes across. I think you can argue successfully there hasn't been a case of a salesperson that runs their own businesses. If it's a company, you have to be the one, S Corp, you have to be the only employee. Okay? And nobody, you must be more than a 5% owner, so if you're in a developer or something. So I think you qualify into this. They specifically say real estate broker, but we've done it for years with real estate salespeople and not had it come up as a question. Okay, material participation each year. The IRS has this wonderful 7-point test. Did you work 500 hours? Do you substantially do all the work? Is it over 100 hours? You need to make sure that you understand the test and that you've kept the records that prove. I've never seen a case where number 7 went. That's kind of a, well, we don't really fit in the rules, but we think we apply. Congress wrote that in, but IRS, it's not something they can define. But if you pretty much go through the others, you're in pretty good shape. But it is important to understand, if you have rental property losses, material participation as a real estate professional, or if you have profits and you're going to have income of over $200,000 single, $250,000, and you look at me and you go, I don't have that, and then you sell that rental property. And we say, gee, it's only a 15% capital gains rate because you held the thing forever, but we had a $200,000 gain on the sale, and you make $50,000 a year, and now we're stuck with this 3.8% Medicare tax. And you didn't keep any of this. Do you follow me?
Yeah.
So it's not only because of the operating, you got to think about what the gains are and when you distribute things if you're going to be there. Okay, high income taxpayers, as I told you, 3.8%. You can stick on if you meet it. Here's the new term, net investment income tax. It's basically Obamacare, Medicare tax. Okay, it's how they thought they would fund this. Okay, and material participation is important. Remember that rental losses and gains. Okay, if you're making money off of it. Activities can be grouped. I talked a little bit about that. For example, you put the 3 triplexes together so that they meet the number of hours tests. Okay. Generally, once an activity has been grouped, it cannot be ungrouped unless you get permission from the IRS. Anybody believe they're actually going to give that? Or make you pay for it. There is a one-time opportunity to redo your groupings in the first year that you have that net investment income tax. So I never grouped my properties. I kept all these records so I know what my total hours were and what the ones for property. And I look at my 3 properties and I say, damn, I'm going to have to pay that net investment income tax. Since this is my first year I've got it, even though my properties weren't grouped, I can now regroup them, or they were grouped differently, I can now regroup them to deal with this. Once I make the election, they're grouped that way forever, but I don't have to make it today till I get there. We follow that? Okay? It's kind of interesting. When I was doing a lot of my research, I said, they let us do that? And we went, and it's in the code. Grouping and regrouping, you have to, when you group these things, there's an election you make on a return and say, I want A, B, and C to be counted as rental real estate, residential, activity number 1. Okay. Another thing that came along this year is IRS finally finished the regs for repairs versus capitalization. Okay, so what they've said is, hey, if it does any kind of improvement, it's got to be capitalized. We don't care how big it is or how small it is. Okay, and an improvement will make with a betterment to the property, so it makes the property better. It restores the property. Now that's an interesting one because maintenance doesn't restore the property, but the answer is, the example they use is I've got a farm tractor and the engine dies and it's no longer a tractor, okay? And I rebuild the engine, I've restored it because it was out of service and it comes back. If I know the farm tractor's engine's going to die and I take it out and I rebuild it or replace it before it dies while it's still in service, then it didn't restore the property. So, this is the IRS. They do not have to make sense. Okay? And it adapts it to a new or different use. I make some changes to the farm tractor, and now it's a hauler or something else if I change its use. All those things, and they apply to real property as well. Result, okay, those amounts end up as an improvement. They have to be capitalized, or they can be an expense if they don't result in an improvement. So if I don't do those things. And that goes into repairs. There's a new safe harbor rule. Cost of regularly scheduled maintenance. This used to be one they used to throw at the airlines. Oh, you're changing out a jet engine. That makes the engine have new life. No, that's maintenance. It's to keep it up and running. But regularly scheduled maintenance do not have to be capitalized. Inspection, cleaning, testing, replacing parts, any kind of recurring maintenance that's on a maintenance schedule. If you're what they call a small taxpayer, and I love the definition of small taxpayer, under $10 million in gross revenue. Okay, so your total rent, now they figure rent a little different, because if you have a lease that's a 10-year lease, they want you to compute that rent forward to hit this $10 million. Okay, but under $10 million, you can elect not to capitalize improvements if the amount that you pay on repairs and improvements combined does not exceed $10,000, the smaller of that, or 2% of the value of the property. So I have and the property's got to have a value of less than $1 million. I got a $500,000 building, 2% or $10,000, and I can expense it. This is the old $500. Oh, you write off $500. It's smaller than $500. Well, they're saying combine it and throw it in here. But you have to make an election to do this, which every rental property I have is going to make the election. Okay? Because I don't frickin' want to start figuring out on all this little stuff. I'm lucky they tell me they did work to the property. Okay, figuring out whether it improved it or repaired it, that's going to be a whole other thing.
This course has been divided into multiple parts for ease of downloading and viewing. It continues with Real Estate Professional, Part 3.